Zoom stock is set to report earnings today in a couple of hours. The stock is down 83% in the past 5 years, so let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to estimate the intrinsic value of the company and potential future returns. Zoom's revenue took a massive jump during the COVID years. It jumped from $600 million to $4 billion. This is why their stock price jumped about 500%. However, since then, the revenue growth has decreased substantially, as now revenue is still at $4 billion, which has led to the stock price to fall 83% in the past 5 years. Analysts are expecting revenue growth to be at around 3 or 4% in the next 5 years, as Zoom is expected to grow to $4.9 billion this year and grow to $5.7 in 2030. Regarding profit, their free cash flow has seen amazing growth in the past decade, growing from $4 million to $1.8 billion currently. And regarding EPS or earnings per share, analysts are expecting Zoom to make $6.05 this year, representing 88% growth, and then grow to $6.60 per share in 2030. If you assign a 15p to the company then, it would make it a $99 stock, representing 23% upside from today's levels. So little upside according to analysts. However, I believe they are going to generate more in profit because they have amazing margins, with gross margin being at 76%, profit margin at 24%, and free cash flow margin at 38%. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. The intrinsic value according to my low assumptions is $65 per share, middle $92, and high $128. And because the stock is currently trading at around $80 per share, this means that if my low assumptions occur, you're going to make a 6.1% annual return on your money, middle 12.7%, and high 19%. As far as my assumptions, I assumed Zoom grows revenue between 3 and 7% annually for the next 7 years, the average of profit margin and free cash flow margin between 30 and 40%, and I assigned the PM price to free cash flow at the end of the 7 years of 14, 16, and 18. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Zoom is trading at a 4 PE and price to free cash flow of 13, and therefore we can conclude that the valuation looks attractive. Zoom also has an amazing balance sheet, as they have $7.7 billion in cash and $54 million in debt, meaning they have tons of cash to either reinvest in the business, buy back shares, or even start paying out a dividend. And in conclusion, Zoom is trading at an attractive valuation, they have an amazing balance sheet, and they have great margins. However, the main question that I have with this company is if it is a one-trick pony, which is why I'm waiting at the moment on this stock. However, if the stock drops on earnings by more than 10%, I think it would be a great opportunity to start a position. Lastly, if you want a discount on stockanalysis.com, the best place I found for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Zoom stock in the comments, and I'll see you in the next one.